especially with like rentals. I'm gonna shit on other people's real estate businesses today. And this is what
Leave the junk collectors alone, man.
Hey, the junk collectors needs a depreciating asset, all right? All right, so we're very pro land, as you can see, very pro land.
Slightly biased.
Slightly biased. Slightly biased, 100%. But everybody's chasing, like, especially, I think it's the funniest thing because everybody's chasing, like, even the best investors are chasing like 15 to 20% ROI. And they're like, it's so hard to get this, and they're doing houses, and they'll go buy a rental.
If we can get a 30% yield, we're good. We're good.
Yeah. 30% yield. I could double my money every 3 years. I'm killing it. You know, I'm killing the game. And then they invite us to speak. I love the land game because you can create a crazy ROI very, very easily.
Yeah, and it's something like you have to think about it, right? The deals that you're going to sell is like a unit per measurement. So if you have a house, right, or a commercial building, you know, some kind of facility, everything's by the square foot, right? So I'm going to buy 2,000 square feet, or I'm going to buy 50,000 square feet, or 100,000 square feet, right? And you have to, there's like some kind of formula where you can extract a certain amount of capital per unit. Well, 50,000 square foot house is unheard of. A 50,000 square foot building, like Logan Fulmer level, like, damn, that's pretty significant, right?
Yeah.
But 50,000 square feet is just right over 1 acre.
Yeah.
Right? So when we go out and we contract or make an offer on 200 acres or 400 acres or 500 acres, like, I mean, you don't have to make that much per unit to have significant returns.
Yeah.
So let's talk about like the types of capital that it takes to move these deals now, right?
Yeah.
So let's say you put a deposit, and you're going to flip this house, and you did a novation, you gave the seller 10 grand or 20 grand. And then at the end of the deal, bang, you make a whopping 60 G's or 80 G's after you flip that house. So maybe like a 4x multiple or whatever, 3x multiple on your little on your 20 grand, but that's a maximum.
Yeah,
you can't go above that, right? Yeah. There's no way to inject 100,000 into it and get a 5x multiple. It just doesn't work that way, right? Because there's not enough square foot in the deal.
But there's a lot of risk too, because you got development costs, time, waiting,
rehab.
permits.
It's a moving target, right? So you're like, man, I papered it all up perfectly. I'm gonna make 50 G's, and then bam, you need a roof. There goes another 12,000 or something, right?
Yeah.
So you have to think about things like that. There's very little margin for error, right? Very little room.
There's not enough profit in there.
No profit in the beginning. A significant amount of capital outlay for very little return, right? So let's say you bought the house cash for 100, fixed it up, sold it for 100, made 50. Right, but in a land deal, like let's say you had 100 acres or 200 acres, you can cut off a very small piece of it and extract a significant amount of capital.
Yep.
So one that we did recently, it was over 200 acres. We sectioned off 30 acres. At closing, we got 50 acres free and clear, and so the seller still has a lien on the rest of the property. Seller finance, 0% interest.
Yep.
But we extracted $600,000 out of the deal within the first 30 or 40 days.
Yep.
Right? So not only did we, we're not restricted to making a small amount like 10, 20, 30% or 30,000, right? We pulled $600,000 out of the deal within the first couple of weeks.
And we still have 190 acres left.
Now, and then wired another 200 yesterday, right? So we pulled $800,000 out of the deal in 2 months, 3 months, 2 months. We just started
most of it in a month.
Okay, so roughly $800,000 in 60-ish days, right? And so how do you think this project's gonna go now that the rest of the project and the subdivide and everything else we're gonna do there, the engineering, has already been funded by the deal, and we already put some cash in our pocket, right? So let's talk about what a good ROI is now.
Yeah, so a lot of people, they think like it's almost like they have to physically produce that ROI. Like I have to paint this, like I always talk about, I always make fun of people on Twitter, they're like, oh, the best ROI is in fresh paint on a new property or fresh house. I always laugh at that because I'm like, okay, you might exit at a higher price, but what's the real ROI? And me and Anthony always say that you can create a higher ROI with a pen and a piece of paper.
Yeah, so instead of you improving the property by painting and putting on a roof, improve the property with your pencil.
Yep, improve the property with your pencil, and improve your deal with your pencil. Mm-hmm. So ask for better terms in the front end and the back end. Have a higher exit multiple of potential spread on the back end. If you buy a 2,000 square foot house, you can only sell it for $250 because of the verifying comps, or $250. There's no max ROI you can get out of that. You can only squeeze it so much.
So let's talk about what's a good ROI from a lender's perspective, right? As a lender and us as a borrower,
Yep.
If somebody lends us, let's say $100,000 to flip a house, and they're expecting a 10% return, $10,000 when you only have a 30% spread, you know, in the best case scenario, right? So you borrow 100, if you paid back 10, that's significant. That really hurts your deal.
That's 30% of your potential profit just to pay the money, guy.
So let's say, you know, if you borrowed 100 grand and you had to pay back 10 or 20,000, that's probably not a deal anymore, just based on what the lender's going to give you.
And you're hunting for the cheapest capital. You're asking your friends and family.
Yeah, you're begging for money that people would lend to you for nothing.
Yeah.
Right. But in the case if you go out and get a bigger deal, right, with more spread in it, you can borrow $500,000 and pay back $250,000. And people were like, "There's no way you could give a 50% ROI." Well, like, not in your world, but in the land world, it's a pretty simple target, right?
Yeah, very simple target. And like the other thing too is like, it's a lot more risk, and that's the underlying risk. Like, hey, we're willing to pay more because underlying risk. You might not.
What are some of the risks?
Some of the risk, the deal may not go well as much as you think it will. So this is one of the things where we target, like, how do you comp land? Well, we comp land because if we know there's comps for 100,000 an acre and we get this deal for 20, how much are you gonna make? I don't know. We might make 50, we might make 80, but we know we're gonna make money.
So if you take a property that has, like, let's say your target profit in the deal is 500,000 to $1 million, and instead of making $1 million, your profit gets halved down to 475. Like, you can still get out of the deal in one piece. You can still pay that lender back 250, and you still make 175 or something.
Yeah, 200,
right?
Yeah,
so no matter what, you're completely protected in the deal. You're not doing it for practice.
Yeah.
Right. So if you're looking for what a good ROI is, I think it really depends on the asset class.
Yep. Absolutely.
The purchase price of the property, and then the amount of exits that you have. So if you flip house, you flip it, you sell it, you put it on the market, seller finance, rent it out, whatever your magic number is. But if you think about it in terms of, I'm going to go after a big giant asset, there's a lot of different exit strategies here, right? So we could do 10-acre lots, we could do 5-acre lots, we could do 1-acre lots.
Oh, I'm gonna dig into this one. That's a good one. Okay. There's multiple exits in land because you're buying at the bottom. So you can go to lot size. You can add paperwork to add buildings, apartments, mobile homes, whatever you want. The sky's the limit to potentially add to that deal to make it worth whatever you want. So then you have multiple exit strategies. Like, do I exit out at 10-acre lots in 90 days, or do I take it to entitlements and do 1-acre lots and profit at that point? And then there's different profit points of different things of development. And we're at Chris Rude's event right now, and there's different phases of exit profitability. You can buy at a good price, you can entitle at a good price, you can build at a good price, and then you can create debt at a good price with notes on the back end. So you have multiple.
And then you can hypothecate the notes out, give yourself a free loan, and go again.
So you can exit multiple times over and over again on land, and you can choose wherever you want to get out.
So I think what's cool about land is exactly what Daniel pointed at, is that you can take a piece of property, right? Let's say you get it for $1 million cash, 100 acres, easy deal, and you're gonna do 10-acre lots. Our target sale for that thing, we want to make 500 to $1 million, no matter what, or we're not going to do the deal. Looking for a 2x return on cash out of pocket.
Minimum.
But if you want to make that property worth $5 million, right, then you invest $500,000 into the deal. Now it's worth $5. And then if you want to go a little bit further than that, you throw in $2 million into the deal. Now it's worth $10, right? So you can continue to increase the price of the property based on the cash outlay and then the time investment, right? So it could take 12 months, 24 months, 36 months. You can't do that with a house. You can't put on a copper roof and put aluminum gutters and do all this crazy, amazing stuff and marble and all that. It doesn't bring the property value.
You hear the term of over remodeling.
Yeah, over remodeling.
Oh, they put a granite countertop in a regular basic flip, and it doesn't even like.
And it didn't bring up the property enough for you to make that profit up, right? So people lose. So what do we call rentals?
I don't know.
Failed flip.
It's a failed.
So somebody got the property, they put too much money into it, and now they can't afford to sell it. They need to rent it out for a couple years to soften up that damage, right? But with land, you just continue to inject time and capital into it, and continues to increase in value and exponentially.
And then then, if you can afford to sit on it, you could just sit on it. We talked to a guy here. He bought 15 infill lots 6 years ago, and he's been sitting on it. He's like, I pay the taxes every year. I didn't really know what to do with it. I built 3 houses on the 15 lots. I still got like 10 left. I sold 2, and he's like, I still got 10 lots left. I'm just gonna sit on it. Like, it is what it is. And then what we tell him, how to extract the ROI. Yep. Like, dude, get paid to sit on it. If you don't need the money, he's like, I don't need the money. Why not seller finance it? Get a down payment, collect interest on that deal. Where he was paying $2,000 a year, he can make $2,000 a month on one of the lots. You know, it's a different ball game. And then if the property comes back to him, guess what? He'll get it back and sell it again. Like, if you don't need the money, this game is very, very easy. And for everybody here, like, if you're experienced, find some good land. I always make the joke. I think it's one of my phrases now. The easiest way to make 10% on your money is to buy a property full price and sell it for 10%. Car dealerships do this all the time. They buy the car from the financing. They're already building their margin. They'll finance you, and then they'll charge you 18%.
They're just a bank.
They're
not a car dealer, right? They're writing mortgages. So if you think about it in terms of, right, to wrap up the video, what's a good ROI? It really depends on what are you after, what's your risk tolerance, and how much do you have to invest, and how long do you have to invest it. So if you invest any amount of capital into an asset that has like a fixed price in the marketplace, hard to get a strong ROI, right? Some of our lenders are getting 50 to 100% gain. So if you think about it, you know, if you're dealing in a space that has those kinds of returns, what do you think the developer or the investor is going to make, right? Absolutely. If we can afford to pay that back. Absolutely. So I think a good ROI is something that you feel safe and secure in, probably something that you understand very well, or you're partnered, right, with somebody that understands what they're doing at a very high level to kind of protect you through the deal. But in my mind, a good ROI is a 2x multiple. So if you put in 100 grand, you should be able to pull out 100 grand. And if I can't pay that to that lender, then I'm probably not interested in the deal anyway, because it's probably not a strong deal, right? So,
and you always want to get a strong deal to secure it, makes your ROI secured.
And also, we don't always pay one for one. It doesn't make sense, you know, in a lot of deals, but it's very, very possible. Okay?
It's very, very possible.
That's not exactly a unicorn deal. It's a very possible deal. And I'll give you an example. So hey, no cap, guys, no cap. You guys aren't wearing caps. You're wearing cowboy hats. Let's say it's a $1 million property. We get seller financing, 0% interest. We borrow 100 from our lender. We give that to the seller. We say, hey, we'll pay you out in 12 months. 12 months, we cut it up into 10-acre lot, sell it, target a $500,000 to $1 million return, and we promise that seller 2x. Well, there goes 100 to the lender, another 100 for the 2 he borrowed. Now we're up 3 to 7.
Yep.
Plenty of room. Absolutely plenty of room.
Plenty of room to create good ROI. So.
Yep.
There you go. I think finding a limitless property and lending on that's the way to do it. Well, I hope you like this video. Like, share, subscribe. You know what to do. We'll see you next time. Thanks, guys.